Welcome to AARP, Arizona Hispanic Connection. Educate. Celebrate. Connect. Arizona Hispanic Connection.
Welcome to Arizona Barrio Stories and Latino USA TV. Welcome to our show. This episode is going to feature David Parra Luna with the AARP Arizona Hispanic Connection. He always has good stuff for us. Very informational. You might want to pull out a pencil and paper and jot a couple of these things down. He always has something good for us. David, welcome. How was your trip to DC?
Thank you, Irma. It was great. Going to DC is always a good thing. There's always nice buildings, and the whole atmosphere is nice. Though most of the times we're working, right? We don't have a lot of time to go sightseeing, but it's very enjoyable. So I'm back. We got some good information from AARP to continue to offer it to the community. And this time around, we continue. We're almost done, Irma. We're almost done with Retirement Bound. So we will be moving to cover some fraud and scams in the next shows, but we still have this one and one more on Retirement Bound. And we are, as I'm sure you remember and know, we are reviewing sources of income that people should be mindful of when it comes to retirement. Whether people are still younger, which is better because you have more time to prepare, or already in 50s or 60s, where you're closer to that time where you have to make so many decisions. So how has it been for you, this series about this reviewing these sources of income?
Well, like I tell you, I wish I would have met you 20, 30 years ago. I think when I was young and I was working, I don't think I really thought about retirement. But now that I am retired, I think, man, I wish I would have known this earlier. So I'm glad this information is being presented now to our audience, because I'm hoping they are better prepared to be retired.
It's very important to understand, to know these vehicles. We could almost say investment vehicles, because as we have said in the past, savings is good, but the money, instead of growing for the most part, it'll be eaten up by inflation. So investment is what makes it grow. So we need to be mindful of that and know about these vehicles. Today we would like to review two items, right? One will be life insurance and annuities. These are another two vehicles that people should be mindful and consider them in when it comes to retirement. So life insurance, right? So it's sometimes I call it death insurance. Sorry. Why? Because you have to die for your beneficiary to get the benefit, but it's called life insurance. Let's review it a little bit, how it works. Again, I am not a financial advisor, so we strongly recommend folks who are interested in these products that we have been reviewing to find one and meet with them and really get the nitty-gritties, and they know about who sells the products and all the ins and outs. So we're just basically providing basic information. So what is a life insurance? Insurance, right? Insurance, we have insurance for everything. And a car, what is it? Your home, even Social Security is a kind of insurance, etc. So the definition of life insurance is a contract between you and an insurance company. In exchange for your premium payments, the insurer pays a lump sum death benefit to your named beneficiary after your death. So basically you're paying insurance, right, so that when you pass away, your beneficiary, it could be a son, daughter, it could be your wife, whoever it is, they can end up with the money. $250,000, $500,000, $1 million, whatever it is. But that amount obviously will affect how much money you will pay in premiums. The beneficiaries can use the money for any purpose they choose. So that's basically the general concept of life insurance. Did you ever buy one?
When we were working, not that we were required, but it was encouraged. So
yeah, at AARP, believe it or not, we offer a life insurance policy. It's not a huge one, but it's there. So I'm very fortunate. I mean, I realize that not a lot of employers have a lot of benefits for the employees. So it helps when the employer provides it, because then it makes it easier. If not, you have to make a decision to do it and start to get educated, etc. So it always helps. There are three types of life insurance. The one is term life insurance. That means it's a policy that provides coverage for a defined length of time. Let's say you just want to make sure that if something was to happen to you, the education of your children is covered. That would be, okay, I want an insurance for 10, 15 years. Once that term is finished, then you stop paying it and it's over. Whatever you paid dies. That would be the term. Or pay for the mortgage in case you passed away or what have you. But that would be one type of life insurance. The other one is whole life, meaning you're going to pay it until you die, right? And there's going to be an amount waiting for the beneficiary. And the whole life insurance, this is coverage for the duration of your insured's life, additional benefits available. These days, there is an add-on to the whole life insurance policy, which is called a cash value. That means that the person who is purchasing the policy can benefit even while he or she is alive, which is an incentive, right? Because in the old days, or before this element was added to life insurance, people said, oh yeah, but until I die, what do I get? But this cash value element, it's an incentive for people to get money while they still are alive. So it says additional benefits available. It's permanent, has fixed premiums, has a cash value, there it is, investment component, and provides more ways to protect your family's finances over the long term. So we've covered two, right? One is a term for a specific amount of years. The other one is for your whole life. And then we have a universal life insurance. This is a form of permanent insurance with flexible premiums and death benefits, but fewer guarantees. So this is another type of life insurance. The cash value, it's a portion, it means that a portion of your premium goes toward the cash value. The money grows, it's tax deferred, and you can withdraw or borrow money, right, against the funds to pay for expenses while you are alive. So this is a new component to this life insurance policy. I don't know how long ago they added it, but I once had a meeting with an advisor and learned about this cash value. It was pretty attractive, honestly, because before this, it was just like whole day. And actually, even the term concept was fairly new to me. Go ahead.
I wonder if there's any penalties associated with that.
With
borrowing against your...
No penalties. There's no penalties, because you're supposed to pay it back, right? The money that you borrow. And then there's options for couples. Life insurance insurance allows for a survivor to maintain quality of life. So if I wanted to buy an insurance, right, and then one passes away, so homeowners may use the money, towards paying the mortgage. Here we go. In case of immature death, sometimes death comes soon, and so then the benefit can pay the mortgage, for example. Life insurance can be purchased from numerous insurance companies or through an agent or broker. This is where it gets hard for me, because a lot of times people ask me, where can I get it? I said, you have to find out. right? Financial advisor would be the best place or the best person to ask, so they can basically guide you through, because there's different companies that sell these policies. We cannot tell you which one. So that would be the life insurance.
Good to know. I bet you people don't think about this until, like I've always said, until something happens.
Right. And now annuity. Annuity is another thing that we have to think about. And just for the sake of time, let's kind of go over some definitions. A person obtains an annuity by handing over a lump sum known as the premium. I'm going to focus the annuity more like when you have like a 401k, and what are you going to do with that money, right? It's time for you to start drawing, so you can roll it over to an annuity. You gave the amount, the whole amount, or part of it to a company that is selling you the annuity, and they will work out the numbers. They'll guarantee you a percentage for life or for a certain number of years. And that's how basically it is, because you don't want that money to be reinvested, right? Because you don't want risk anymore. You're not at the point where you can afford the markets, up and down. So you want to have something, a steady inflow of money. So you basically hand over that money to an annuity, and the annuity pays you monthly, right?
Almost like a mini pension.
Exactly. That's exactly what it is. This is a form of pension created by the annuitant. So, and there's an annuity where you can start getting money immediately, or you can also defer the payout, right? So you can deposit the money, you can pay premiums, and then says, you know what, I don't want my money right now. I want to start drawing in 10 years. So that is called a deferred fixed payout. So this begins in several years, and it is set from the start or at the time payments begin. It's called the accumulation period. So that period where the money is growing, and then you can start withdrawing later on. So that's another type of annuity. And then the deferred variable payout. The premium minus charges is invested. So this is the only type of annuity that the money is invested. So there's risk. So that's why it's called deferred and variable, not fixed, because now you're talking about investing, that money being invested. Annuities are funded by a single payment or multiple premiums. And so I think that's pretty much how these annuities work. Obviously, when you buy an annuity, it's going to depend on the age of the person buying, the gender, and then the guaranteed interest rate at the time of purchase. So it's very, very important to understand all these things. They have to read the fine print, of course. And then if you want to cancel it before it matures, there's going to be penalties involved. So always be mindful of the small print. And then there are also policies for for spouses, for couples, I should say, so that if one passes away, the other one can continue to receive. Obviously, you're going to get less money because now you are, you are guaranteeing a benefit for the spouse. One thing to be very mindful about annuities is inflation, because it's going to be a fixed amount forever, so to speak, right? So inflation is going to eat up that money. So that is a concern that we all should have when we talk about annuities. There are annuities that can take care of the inflation. In other words, they adjust to the inflation, but the amount you're going to get obviously is going to be less. All kinds of moving parts in these products, but a financial advisor is the place to go to, so they can kind of go over the actual plans available. And then remember, always read the fine print. There will be fees involved, more so on the surrender part, because if you get a fixed immediate annuity, there's no fee, because it's already taken care of with the amount that they're paying you monthly. So
my advice to people would be, do your research and ask a lot of questions.
Definitely, very important. I think they should do it. I think be mindful. There's the life insurance policies, and then the annuities as two other vehicles to generate income for retirement. There you have it.
David, thank you, and hopefully somebody will benefit from this.
I agree with you, and I think it's once you know, then you can plan. Thank you.
Well, you heard him. Lots of stuff to think about. Like I said, do your research, ask questions, make sure you know what you're getting into. Thank you from Arizona Barrio Stories and Latino USA TV. Thank you, and we hope to see you soon.